Okay, welcome everybody. My name is Anya Aleman. I'm the Innovation Director here at Ascender. So I am very excited today to welcome Carissa Habsburg from Sisterson Co. She's a CPA and Tax Manager there at that organization. She's going to be presenting on how to get you ready for tax season this year. We wanted to make sure that we organize this event early on in January to make sure that you are as ready as you can be to really get all of your tax materials before the tax date deadline. So I'm gonna let Carissa introduce herself and tell us a little bit more about her organization and her role in her organization. So I'm gonna pass it on to you, Carissa.
Thanks, Ania. Hi, everyone. Thank you so much for being here. It's nice to see some of your faces, to put a face to some of these names in this increasingly virtual world we've got going on. And I appreciate that you're willing to show your face too. I am a tax manager at Sisterson. I've worked for Sisterson for about 10 years now, and throughout that 10 years, I've worked with a lot of startups. Sisterson probably has somewhere around 60 to 70 startups at various stages. And I say startups because you could be a 10 to 15-year startup if you're going through FDA approval. And so we work with companies not only in the startup phase, but also as they grow, manufacturing companies, not-for-profits, printing companies, and so on. I personally enjoy working with startups because you guys are a Jack and Jane of all trades. That's kind of the name of the game in the startup world. And so I'll be talking a little bit about things to pay attention to early on as you grow. And if your goal is to potentially exit, a lot of the topics that I bring up now are likely to come up in that due diligence process. I encourage you to please ask questions in the group chat. And I know Ania is going to ask a question of everyone just so I can frame some of the topics that I'm going to discuss. Lastly, you'll find that there is a decent bit of information on my slides, but you don't need to write it all down. Some of it is just mere informational. I'm going to hit the highlights and key points that you want to either jot down or remember, 5 years from now, hey, this might be important. Okay. So with that, Ania, I'll turn it back to you.
For sure. We're going to be launching a poll because we want to learn a little bit about who's here today. So if you don't mind filling it out real quick.
Okay. All right, so I see we have a couple C Corps, single member LLC wins by far, and then multi-member LLCs, which are single member LLCs just with more than one member. I see no not-for-profits, B Corps, or S Corps. Okay, that's really helpful. That's really helpful. Okay. Okay. All right. And with that, I think I'm going to share my screen. Is that okay, Ania?
Yes, go ahead.
Perfect. All right. So I'm going to share my screen and it is simply a presentation. And if anyone has any questions, please feel free to let me know and we can stop. And I plan on speaking for about 25 minutes or so. And if and when you guys want to, if you have a question, please feel free to, and we're going to talk about them at the very end. I want this to be interactive and ask your questions because I feed off of those. It makes me happy, okay? First and foremost, I'm a nerd to the nth degree. You'll find that out as we continue to chat, but thank you for sharing the type of entity you chose. One of the reasons why I asked that question is in the tax world of startups, you guys tend to not make money early on. As much as you think you have a billion-dollar idea, you're spending a lot of money to make that idea a reality. And the type of entity, if you've already formed, is already taken care of. But what I want you guys to pay attention to is I'm going to start out with the LLC, the multi-member and the single member LLC. Generally, the question of how losses get allocated is a very important question to a startup, because if you get funding from an outside source, let's say you're not bootstrapping it, let's say CMU or Innovation Works, for example, puts money into your entity. The question of who gets the loss that's generated from the entity is one of the biggest issues. And it's actually one of the biggest mistakes that I see on tax returns that I inherit. What I'd like you to take away from this first piece is you need to pay attention to how losses get allocated, because as an LLC, you are a pass-through entity. That means that the entity doesn't get taxed. You pass the income and loss out. And those losses might not be allocable to you in order to offset other sources of income that you or your spouse might have. So the question of how losses get allocated tends to be based off of who is funding that loss. And if you're not funding that loss, you don't have what's called tax basis to deduct that loss. And I kind of just dove right into a tax concept, tax basis and everything else, but you should at least think about, am I paying for what loss is running through my tax return? And if not, I might have an issue on whether or not I can use that loss to offset other sources of income, like let's say your spouse has a W-2, okay? So that's one thing I want you guys to pay attention to. Now on over to those C Corps, because there are a couple C Corps out there. You might recall that I mentioned earlier that an LLC is a pass-through entity. That is, the income doesn't get taxed at the entity level, but it gets passed out to its owners and reported on your individual tax returns. Yeah? A C corporation is different. A C corporation is taxed at the entity level, and then that income gets passed out to its owners via what's called a dividend. Yeah. The concept of double taxation is something that a lot of people don't necessarily like to form as a C corporation because they stay clear of that. They don't like that concept, double taxation. But in the startup world, a C Corp is actually quite common. And the reason is because investors don't like to wait for an entity's tax return to be done if you were an LLC, because a K-1 would need to be passed out to its owners. There's tons of LLCs out there, single member LLCs, and that's not a big deal. But the fact that your entity's tax return needs to be done tends to be a reason why an investor might not invest in you and require you to convert eventually to a C Corp. This is a tidbit that you might not know, and it'll save you money in the long run, ladies and gents. Legally, you can stay as an LLC, but you could convert for tax purposes to a C Corp. And it's a one-page form. It's a very simple form, and I see that happen all the time. It'll save you money, legal money in the long run, unless your investor is legally requiring you to convert to a C Corp. Okay? Back to that concept of double taxation for a C Corp. A C Corp is taxed at the entity level, and then when it takes the money out via dividends, it's taxed again. If you remember anything from this presentation, C Corps, write this down. Code section 1202. And if you Google this, I promise you, you will find tons of information on it. But here's how it works. If you're a C Corp and you are an individual and you own your stock for 5 years, not 4 years and 11 months, 5 years, and you sell your stock, not your assets, you can exclude up to $10 million per individual from federal capital gain. It's a home run. I've seen quite a few startups, quite a few of my startups have done this. But here's how it works, just as an example. Let's say there's 4 people who own the entity, 2 of which are individuals and 2 of which are not-for-profits. Let's say it's CMU and Innovation Works. And you each own 25% and you sell the company for $40 million. You each get $10 million, way to go you. But only the 2 individuals get to exclude each their $10 million from federal capital gain. Sometimes this is a reason to convert to a C Corp sooner rather than later, so it starts that 5-year holding period. The takeaway is you need to consider you need to consider having the stock sold and hold it for 5 years. Okay. The last item on this slide is just a reminder for an 83B election. An 83B election is a legal document that usually, if your attorney is working with startups quite often, they will make sure that this is something you know about, but there's a timing associated with it. The 83B election basically is for vested investing shares, and it needs to be attached to your entity's return, as well as filed within 30 days if you get your stock or units. If you have questions on what that is, let me know and we could talk about that after this. Okay. So the tools of an entrepreneur: early stage investors, you're getting all the help you can get from the people around you, board of directors, investors, peer. And your early stage advisors are key to making sure you're doing things right the first time, which is actually the name of the presentation, right? Doing things right the first time might cost you more sometimes, but in the long run, it'll help you and might end up costing you less. Legal counsel, outsourcing payroll taxes, we'll talk about in some of these accounting concepts. Okay. So accounting, getting ready for tax season. What is important? If you're an early stage entity, what is important to give your tax person? Well, if you guys are keeping the books internally and you're not using something like a QuickBooks or a Xero or anything like that, Excel is often okay to use in the first year. But the most important thing is that you are keeping a summary of cash receipts and cash disbursements by category. So cash receipts, income, or convertible notes or equity, cash disbursements, legal costs, rent. However, but if you can summarize that information, that's ideal. The burden of proof, if the IRS was to audit you to make sure those deductions are legitimate deductions, is on you. So making sure you're keeping good records. I know that sounds oxymoronic, but you would be surprised how things can get pushed to the wayside when you guys have so many other things going on. If you need accounting, if you have inventory, I highly recommend getting accounting software right off the bat, because you would be surprised how inefficient it is to track things in as many spreadsheets as might be required. More often than not, an investor, if you're looking for money, is going to ask you for financial statements. And you might say, well, Carissa, thanks. That's obvious. But if it takes you about a week to get those financials together, I can't guarantee that deal will fall through, but they might take a closer look at what you're providing them because they might not see that you have your act together. So the sooner you can get a set of financials together, the better. It'll help not only you personally figure out what the status of your business is, but also it might be the difference between whether or not you get some funding to help your business grow. Okay. Payroll taxes. Payroll taxes are one of those things that have hidden treasures. And when I say treasures, I don't really mean the good kind, I mean the bad kind, where you don't know what you don't know. There are federal, state, and local payroll taxes. Oftentimes, if you are trying to do payroll yourself, there may be some small things that you're missing, and there are quarterly, semi-annual, and annual reports. What I'd like for you to take out of this slide is you would be surprised how inexpensive it is to outsource bookkeeping. I don't do bookkeeping. That's not my cup of tea. I know what issues could exist in bookkeeping, but my point is that it's their bread and butter, and it's relatively inexpensive to outsource this. So if you have an employee, you should consider outsourcing it. The difference between an independent contractor versus an employee is somewhat of a hot button, particularly with Uber on the East Coast or the West Coast and everything else going on out there. But the concept independent contractor versus an employee is something that you should consider every time you look to work with someone. There's a filing deadline coming up the end of this month for all of the 1099s. And actually the 1099 NEC should be replacing the 1099 MISC, miscellaneous. That's a new form this year on my slide. The 1099 NEC is the form that is due to independent contractors for the work that they've done if you paid them $600 or more for services. It's very important that you issue those within the next couple of weeks. You could do it online via QuickBooks. You can request carbon copies. What's important to know though is you can't just print it off of the internet and send it. The IRS requires special ink. So just a little tidbit there. Employees get a W-2. Independent contractors get 1099s, NEC. The difference between the two is control. Think control. Are you controlling what this person is doing? If the independent contractor is invoicing you for their time and they're doing it for other people, they have a business card. It is likely that you have an independent contractor. As a small business, you're motivated to treat more people as independent contractors than as employees. The reason for that is you don't have to set up payroll. You don't have that incremental cost. The second reason is you don't have to pay for the employer portion of payroll taxes. But the IRS realizes that, and they much prefer employees because they get their chunk of change a whole lot faster and more regularly than an independent contractor. At the end of the day, before you make a payment to either an employee or an independent contractor, you should get a Form I-9 if it's an employee. That proves to you that that person has the right to work in the United States. You get two forms of ID, a W-2 or a driver's license and a birth certificate, something like that. It doesn't get filed anywhere, you just keep it. If you have an independent contractor, you get a Form W-9, and that W-9 tells you their name, address, and social security number, or EIN, so that you can file these 1099s. And I guarantee it, if you tell them you're not paying them until they give you the W-9, they'll give you the W-9, because you don't want to be asking them like 10 months later when you don't like them anymore, like, hey, where's your W-9? So that's an important thing. Before you pay anyone, make sure system's in place, okay? Because you're on the hook if you're not doing this properly as an owner. Early stage issues, I'm not going to spend too much time on this slide. This is a little bit more informational, but the first category is where if you were to register with Pennsylvania, Pennsylvania has a form PA 100, which is done online. This is a one-stop shopping to file for your PA payroll account numbers, which is like your withholding of numbers, your unemployment compensation numbers. If you are required to collect and remit sales tax, this is where you're going to get all of that kind of thing. Legal counsel does not do this. The second item is convertible debt. This is a very, very common early stage way to get money in the door. What you should take away from this is interest accrues with convertible notes on an annual basis. That interest is income to the person who gave you the money via the convertible note every year as it accrues. The due date for the form required to be issued to the individual is the end of this month. A 1099 OID should be issued for the accrued interest to the note holder. Okay. Getting a W-9 from all of the note holders gives you their name, address, and social security number, so you know who to issue OIDs to. 1099 OIDs. There's exceptions. Not-for-profits don't get them. C corporations don't get them. And there are other tiny exceptions, but just big picture, if you're paying someone, if you have a convertible note, take a look to see if you have interest and or a requirement to issue these before the end of this month. Stock options, that's something a little bit down the road and beyond the discussion, but this is an area where there could be some tax consequences. So just be proactive on that front. Okay. The last item before I get into the tax credits is, when does business begin? You might say as a startup, you're losing money because you're spending a lot of money, but whether or not you actually get a tax deduction for all of those costs is in question, because there are rules that say you cannot take certain deductions until you begin business. And the idea of beginning business is, in a nutshell, when can you tell the world, hey, come buy my product? When is your product or service ready for sale? Okay. And so there's some issues associated with that whenever you are looking to prepare a tax return. Tax credits. We're going to look at R&D and the KIZ. The job creation tax credit, I just found out, actually was not funded for this year. So the job creation tax credit may be funded again in the future, but not anymore for this year. Everyone's out of money. It's the way that works, right? The R&D tax credit is a credit that's based off of 3 expenses: wages, supplies, and independent contractors. Research and development is what you guys do, right? That's what you're spending your money on. And you're already spending the money, you might as well get a tax credit while you're at it. So what qualifies for this credit? Wages, supplies, and independent contractors. Wages for the proportion of time spent doing R&D. So let's say 70% of your time is spent doing R&D. You pay yourself $100,000, just to make my example easy. $70,000 qualifies for the credit. Supplies consumed in the R&D process. Those are your test tubes, your chemicals, whatever it is, if you have a widget you're developing. Third, independent contractors. If you're outsourcing the development, you know you're outsourcing the development, okay? The federal credit is part of your entity's tax return. Pennsylvania has a separate application, but you need 2 years in order to qualify for the PA credit. The takeaway from this is that the Pennsylvania credit can be sold for cash. There's a very ready market for this tax credit, and you can get around 80 to 90 cents on the dollar to sell this Pennsylvania R&D tax credit. It's free money, guys. So if you're doing R&D, this is something you should focus on, okay? The federal credit can actually be used to offset payroll taxes, and it's part of your federal tax return. We could talk about that if you have questions. The last item that I'm going to talk about is the Keystone Innovation Zone tax credit. This tax credit is a credit that's based off of an increase in revenue year over year. That includes grant revenue. If you're getting grant revenue, does not include PPP because that's a loan, if you're going to ask me that question. But this credit requires you to be inside of a geographic location. There are 2 zones inside of Pittsburgh. The Greater Central and the Pittsburgh, the Greater Oakland and the Pittsburgh Central. Whew, that was rough. And you can be inside the zone in one 100 block and out of it the next. So there's a map, there's an interactive map, and there's like a Word document listing. It's kind of ridiculous. But this is a Pennsylvania credit that can be sold for cash as well. Again, you're already doing what you're doing. You might as well get a credit for it, and it's free money, okay? So those 2 tax credits are one of the most common tax credits that a startup will use and potentially be able to sell. And it makes a difference because it reduces the outflow of cash that you have to put out, okay? That being said, those are the topics, the high level big thinking that I just wanted to impart on you. Some of it is immediate, some of it is future, some of it pertains to you first year, some of it can pertain to you in 5 years. But what you should look at is recognizing that there are certain situations that you don't know what you don't know. Hopefully I've put a little bug in your ear. You remember 1202, 5 years down the road, C corporations. There could be tax planning opportunities surrounding that. And if LLCs, you might not think you can take you might not be able to take tax deductions that you otherwise would have thought. I can go into more detail, but does anyone have any questions, thoughts, concerns, complaints?
Someone had a question about if the Keystone Innovation Zone if it's only for the state of PA.
So yes, this is a Keystone Innovation Zone tax credit that is a PA credit. However, other states do have a similar type of credit. Keystone is a PA name, but there are credits and incentives all across the country. New York has an R&D tax credit. Texas has one. Depending upon where you're doing business, generally certain demographics are trying to incentivize certain businesses to locate there. And there are tons of incentives, tax incentives across the country. So to answer your question, yes, this is a PA only tax credit, but there are tax credits if you have other locations you were wondering about.
There is also another question in the chat box, Carissa. How is the Keystone Innovation tax realized? We applied and we heard we were good to go, met all of the requirements, but haven't seen any information yet. This question is from Fraser.
So did you let them know you were in the zone, or did you apply for the credit? Letting them know that you're inside the zone and you qualify for the credit, I tend to hear people say, hey, you're good to go. The actual application process requires 2 years of gross receipts. And if that is what you're asking about, you should have been alerted by the 15th of December. My contacts with the state say that they are a month behind. So Pennsylvania awards credits on the 15th of December, which obviously already passed. My contacts said that they weren't going to give them until January 15th. And it's obviously beyond that. And I haven't gotten any award letters from my clients. So if you applied for the credit and haven't gotten it yet, I would hang tight until maybe give it another week. And if not, reach out to whoever helped you apply for the credit. Okay. Good question. And if I didn't answer it, please ask again or a different way. Should I open the chat box? Is that helpful?
Yeah, are we moving to the Q&A section now, Carissa?
Yes, I believe so. Those are the slides that I have. So I can keep talking if you guys have any more questions, but I like questions. So sometimes that's a little bit more helpful.
Yeah, everybody. So we have built in a lot of time for Q&A. So, Carissa is well versed into answering a lot of your questions. So feel free to either send the questions in the chat box or just unmute yourself and then ask a question if you have one right now.
Hey, Carissa, I have a question. This is Fraser again. Do you mind going back to the 1099 section? My company hired a few contractors and I didn't ask for W-9s from all of them, or at least I don't remember doing that. So do I need to go back out and ask for those?
Unfortunately, the answer is yes. And going forward, before you pay anyone, you should request that W-9, because like I said, I guarantee you they'll give you it if they want money. They want paid. They are by law required to give you this W-9 so that you can file these 1099 NECs on a timely basis. And the due date is the end of this month if you're paper filing them. If you're electronically filing them, you have a little bit more time. I think the due date is the end of March, but they're still due to the recipient by the end of January. So why the IRS in Pennsylvania extends that, who knows? But at the end of the day, you got to get this W-9. Thanks for your question,
Yeah,
Fraser.
thanks.
Hi, it's Jeanette here. Quick question. If there's two members of the LLC, if one of the members of the LLC is the independent contractor, does a W-9 still need to be filled out?
So I'm glad you asked that question, and I didn't spend too much time on this topic, but as an owner of an LLC, you do not get a 1099, nor do you get a W-2. You get a Schedule K-1, which comes from the entity's tax return. And you get what's called a guaranteed payment. And that guaranteed payment is what gets reported on the K-1 to show how much money you were paid throughout the year. What's important to realize though, and I think you made this correlation, so that's really great, is that you are not a W-2 employee and therefore cannot have taxes withheld from the money that you receive, Jeanette, and that's great. But you also you're not an independent contractor either. You are a K-1, an owner of that LLC. So you are required to pay your estimates quarterly on the income of the entity, if it has any income, and the guaranteed payments that you get paid on a quarterly basis, federal, state, and local. A W-9 is going to be needed for your tax return anyways, or whoever prepares your tax return is going to need your name, address, and social security number. So you can give it to them via that if that's helpful to you, or another method. Does that answer your question, Jeanette?
Yeah, the only question that I still have is that so the guaranteed payment goes to the two owners, but one of the owners gets paid monthly by billing. So he has an independent company that is getting paid through the other company. Does that make sense?
So this person has a separate company from the entity you're referring to, and he's
Correct.
paid. So it sounds like there is a potential deduction on the multi-member LLC, and then income gets picked up in his separate entity.
Correct.
So if he is getting paid that method, then a 1099 should be issued to him. It sounds like his separate entity would provide that W-9.
Okay.
And the IRS says that if someone gets a deduction, someone else has to pick up income. That's how it works with the IRS. Generally, in general, that's how it works.
Right.
So if his entity is doing the work via a 1099, then yeah, that's appropriate.
I think Shreya had a question.
Hi, hi, Carissa.
Hi.
So my question was, so we have a C corp, and if we were to raise, let's say, angel investment, would that be considered revenue, and would that, and with respect to taxes, right? So would we be able to claim the R&D credits or the KISS credits for those? I was not sure because, typically when we raise investments against like a convertible note or some such, so.
That's a great question, Shreyas. Equity raises or convertible note raises do not count as income. Convertible note raises are liabilities on the balance sheet. Equity raises are equity on the balance sheet. They do not go to the P&L, the profit and loss statement, as income. Income is grant revenue. Income is sales for whatever it is that your business is looking to do. And it makes sense because this credit is there to incentivize businesses to locate, growing businesses to locate inside these zones. So that the money will be used for the R&D credit. I mean, you could qualify for the use of the money for the R&D credit, but it is not income for the KIZ tax credit. Does that answer your question?
Yes, I think so. But for the R&D credit as well, so for the R&D credit, you're saying they don't need to see income?
Correct. The R&D credit is an expense type credit where you are spending money on R&D. They want to see you spending the money inside of Pennsylvania on research and development. And remember, those three categories are wages for the proportion of time spent doing R&D, supplies, if you're spending money to that are consumed in the R&D process, like chemicals or widget A, B goes into C, or independent contractors, if you're outsourcing the development of your application, perhaps to like a TrueFit or something like that. Those expenses qualify for the R&D tax credit, both the federal and Pennsylvania.
Got it. Okay, that makes sense. Thank you.
Good stuff. What else you guys got? This is fun. I see a question about how is the KIZ tax credit realized? Okay, we heard about it. I see. I think I already answered that one. Let me see if there's any others.
There is one, Carissa, from Daniel. Sorry if I misspoke your name. It says, since we are incorporated in Delaware, but foreign qualified in California, should we look at Delaware or California for something similar to the Keystone Innovation Zone credit?
The fact that you are incorporated in Delaware is irrelevant. The reason for that is unless you're operating your business out of Delaware, there's no opportunity to get a tax credit, nor do you have to file a tax return unless you've registered to do business in Delaware. Tax credits, remember, are good for taxes to be paid in the future. I'm not sure I understand your meaning behind the foreign qualified in California. Are you doing business in California, or are you a Pennsylvania entity that is qualified to do business in California? I'm not sure I get that part. Regardless, if you're doing business across the country in a particular state, you should definitely look in to see what kind of credits are available in that state. Startups, there's just so much incentive out there to incentivize you guys, and you guys are the future, and that's what they want to throw money at, you know. Also, as an aside, with everything going on with the coronavirus and everything, I've gotten questions from some of my startups. Are they still going to be funding these projects? And what's interesting is they've been able to divert some funding that would have gone to other unused resources to some of these startups. They're still sending money your way. So when the budget gets approved and how everything is going in the future, we'll see how much gets thrown your way to startups, but it's not, the pot hasn't dried up, so to speak, which was encouraging to me.
Carissa, I have a question. Can you provide us with examples of startup write-offs costs that that attendees can be, aware of?
Sure. So as a startup, hopefully you're keeping all of your receipts, but many of the costs should be relatively straightforward. Like if you are paying legal costs, or if you are entertaining meals, entertainment. Some of those costs, though, might be limited, and whether or not how much of it is deductible, because meals are limited to 50% deductibility, because that's an area rife with abuse. So the IRS says, too bad, so sad, you don't get 100% deduction. Entertainment, let's say you take someone out to play golf, because that's one of the few things you could socially distance on in this world right now. Golf is not a deduction anymore because it's considered entertainment, and that's 0% deductible. Some items, though, for the sole proprietors, those individuals who are sole proprietors in this discussion, or single member LLC, there's a home office deduction where if you're paying, your real estate taxes, some of your utilities, whatever percentage of your home that is being used exclusively for business, you could potentially have a deduction if you're making money, if you have overall income, for your home office, and that's sometimes a missed deduction potential. But there's a practical side to this too. Sometimes gathering all of the receipts and doing the work is not worth the effort and the deduction. Why is that, you ask? I'm glad you asked. The reason for that is, in order to benefit from this deduction, you have to be making money. So sometimes you have to have income to offset. So sometimes it's not worth all of the time that it takes to gather the information. Another deduction could be the use of your vehicle. If you are an individual who travels a lot for his or her business, you could do a standard, you could use the standard rate, which is 0.545, I think, for 2020. Don't quote me on that. It's somewhere around there. Times the number of miles. And so that's a potential deduction for you as well. At the end of the day, your goal is to make sure you're keeping your receipts. And if you have any specific questions or anything you're wondering about, please let me know. But those are some high level ones that I see missed often. Dan Yoon said that I'm doing business in California, but heard that you could carry forward the loss. So it still makes sense to claim home expenses for this year to carry a loss forward, even if there's no income this year. Yes, federal, the deductions associated with the home office, home expenses could potentially be carried forward. It depends on your fact pattern. It's really hard. I have to be careful because I have to speak in general. I don't know everyone's individual tax position, so I have to be a little bit careful when I say this, but California, like Pennsylvania, for example, does not allow you to carry a loss forward on your Schedule C. Losses are also not allowed. Losses on your Schedule C, if you're a sole proprietor, can also not offset other sources of income. So let's say you had $50,000 worth of W-2 income in Pennsylvania and a $50,000 loss on your Schedule C. Pennsylvania does not allow you to net the two and pay no tax. I know, PA is a jerk, but those are the rules. I don't make them up. So I'm not sure if that answers your question, but I just wanted to mention that. Any other questions?
Yeah, one more 1099 one. So do we need a W-9 from every contractor for every year? So if we have a multi-year, someone we've used over multiple years, do we need to ask them for a new form every single year? Or does anything change from year to year? Or?
Well, you could ask them that. When you request a W-9, the question will be is, have they changed addresses? Have they moved? Their taxpayer ID shouldn't change. I mean, it's possible that they could change. Let's say they form a new entity and they're doing business inside that entity instead. I would hope that you would know. It's a good practice to get in the habit of just simply requesting it on an annual basis. It really, all it does, Fraser, is it takes your time. So it depends on how detailed you want to get. I recommend asking for it every year if it's not a burden to you, just in case.
Carissa, I'm curious about how those sort of like the CARES Act and all of the different, tax incentives and programs that happen because of the coronavirus may affect the tax filing this year.
Yeah, so that's a very good question. And there are so many things out there. So I'm going to take this very high level. If your business has existed for more than a year, it's possible that you applied for a PPP loan. That loan is reported, at least Sisterson's position, my position at our firm is that it's reported as a loan. It is not considered income until it is forgiven. But that income is not taxable, and the IRS released rules associated with that. I could talk a little bit more in detail, but I'm keeping this in layman's terms, okay? You are also able to take a deduction for the expenses that were used for the PPP, from the PPP loan. If it's forgiven or it's not, regardless, they're deductible. There is an EIDL loan out there where the first 10,000 of it was considered a grant. That is considered income to you and taxable. The remaining piece is a loan. That loan is something that you will report on your balance sheet and repay. You should be accruing interest equal to whatever the loan says, which I believe it is 3.75% per year. Okay. There are other payroll credits out there. Early stage companies don't always qualify for some of those payroll credits because you need to make sure to either have payroll. Some of my clients just don't even have payroll. They're using independent contractors. But what I would recommend there is if you are a startup and you do have payroll and you think you may qualify for some of the payroll credits out there, even if you don't even know about them, reach out to your payroll provider to see what, if anything, can be done to help on that. The type of credits that are out there are deferral of how fast you guys have to pay the employer portion of taxes. There are credits out there if you paid someone who might have been laid off for a period of time. There's just a lot of nuance to the CARES Act. So big picture, there's a PPP loan, which is a loan until it's forgiven. There's the EIDL loan, which is a loan and will not be forgiven, and you should be accruing interest. Okay. There are payroll tax credits out there. And then, you know, these stimulus checks that we're getting, guys and gals, those are not income to any of us. How they're going to be dealt with on the tax return, they've not released the forms yet. So I wish I had a little bit more information on that, but there's potential to have fun with that too on your tax returns. Thanks for that question, Ania. Does anyone have any specific questions, however, related to it as it refers to their situation? No, you guys are just having a good old time listening to me talk about taxes. Cool kids do taxes, guys. Come on now.
Any more questions for Carissa?
Yeah, I have one on the timing of the PA R&D tax credit. Do we know when that is going to be awarded, or like when again do you get that in the mail, or what however it shows up?
Yes, so the PA R&D tax credit is a separate application that is done during the summer months, and they actually do not release it until the summer. When you apply for the credit, they do not award the credit until the application period is closed, and that application period closes September 15th. They then have until December 15th to award those tax credits. I'm not sure who asked the question, but I do know that they did already award the PA R&D tax credits. There is a place you can go if you did not get your award letter on the DCED's website, the Department of Community and Economic Development, that's Pennsylvania's website, to figure out what credit you were awarded. So if you're unsure and you applied for the credit and you have not received your award letter yet, I would recommend going out and looking for it. And as a follow-up, Ania, I will send you the link and the PDF because I've already pulled it. For my clients, it's a big deal, and sometimes my clients don't get me their information. So I go out and I look for it myself sometimes.
Sounds good. Thank you, Carissa.
Yeah.
That was a great answer. That was perfect. Thank you.
Sure. Pennsylvania, unfortunately, is a little bit behind on the KIZ tax credits, like I said. But there are other tax credits out there, ladies and gents, like the work opportunity tax credit. If you're employing unemployed individuals, or veterans, or, you know, it's targeted to a specific socioeconomic group of people. There are federal tax credits out there, the work opportunity tax credit. That's not always done in the startup world, but it is available. What else you guys got for me?
Yeah, we have a few minutes left, so feel free to, ask away or write in the chat box.
Yeah, and please interrupt me because I'm gonna say a few parting words in the meantime, but one of the things that I always say is the devil's in the details. There's a lot of things you all have to focus on. The question is how much of your time should be spent doing some of these things. I really do encourage you to hire a bookkeeper, talk to your peers, talk to your colleagues, because you could hire a bookkeeper for an hour a month or 5 hours a month. You don't need a full-time bookkeeper, but you would be surprised how inexpensive someone like that is early on. I do understand too, cash is king in the startup world. It's so important to preserve cash. But sometimes that's a good use of your time because you might end up spending more money paying, I don't know, your tax preparer to put together a set of books that's usable for the tax return. But if you had a bookkeeper, you could have had them all year long to provide and see where you're at as a business. So I'll get off that soapbox. I don't do bookkeeping. I could do it, but it's not cost effective for someone like me. So I'm not saying this from my perspective. I'm just trying to make your lives easier, ladies and gents. I see Jeremy's comment. Jeremy, certainly I'd be willing to chat if you have any other questions, please. I think my contact information is available. I'm working from home and I get voicemails to my email. So if you don't get an answer on the phone number that's provided, I will return your call as soon as I can. Just leave a voicemail or shoot me an email, better yet. I don't mind questions. There's never a similar situation. Everything's always different, right? You never have the same thing happen twice.
Absolutely. And we'll be sending out to everybody who registered a survey and also supporting materials that can help you out as you continue your journey with tax season, and also Carissa's information as well for you to reach out if that's something that you're interested in. But if you have any more questions, we'll be here for another few minutes. If not, thank you very much for joining us,